Yo, America! Let's dive into something super important today. We're talking about the Fed, the Federal Reserve, the backbone of our financial system. Think of them as the referees of our economy. But instead of whistles, they use interest rates to make calls. This rate, known as the Fed rate, acts like the base price for banks to borrow money from each other. Banks, in turn, are kind of like the middlemen of money. They borrow from the Fed and lend it out to us, the people. So, they get money from the Fed and then lend it to us for things like homes, cars, and businesses. When the Fed rate goes up, borrowing gets more expensive for banks, which means higher interest rates on our loans. That translates to higher interest rates on our loans, credit cards, mortgages, the whole shebang. On the flip side, when the Fed cuts rates, borrowing gets cheaper for banks, making it easier for them to lend money. And guess what? That usually means lower interest rates for us too, making loans and credit more affordable. It's like a sale, but for money. Lower rates can stimulate spending and investment. But hold up, it's not that simple. There are many factors at play. The Fed doesn't just slash rates for fun. They carefully analyze economic data and trends. They're playing a high-stakes game, trying to keep the economy humming along smoothly. More on that later. Stay tuned. So, why would the Fed ever want to cut rates and make borrowing cheaper? Think of it like this. The economy's a car, and the Fed's the driver. Sometimes that car needs a little boost to keep going. When the economy slows down, people spend less, businesses hurt, and jobs are lost. Not good, right? That's when the Fed might step in and cut rates. Lower rates are like stepping on the gas pedal. They encourage people to borrow more, businesses to invest more, and hopefully the economy to pick up speed again. But here's the catch. The Fed can't just floor it all the time. Too much gas, meaning rates too low for too long, can lead to inflation. That's when prices go up and your dollar doesn't buy as much. Remember the 70s? Yeah, nobody wants that. Alright, let's get real estate for a second. One of the biggest ways Fed rate cuts hit home is through mortgages. See, when the Fed cuts rates, those cuts often trickle down to mortgage rates too. Now, imagine you're about to buy a house. Suddenly, mortgage rates drop. Sweet! That means you could afford a bigger loan, a nicer place, or at least have a smaller monthly payment. Cheaper mortgages mean more people can jump into the housing market. More buyers, more demand, and bam, you guessed it, prices go up. That's why real estate often heats up after Fed rate cuts. But hold your horses, house hunters. It's not a guaranteed win. Remember, higher demand can also mean more competition, bidding wars, and maybe even overpaying for that dream home. Okay, so we've covered cheap mortgages and the housing hype. It's clear that lower mortgage rates can make home ownership more accessible for many people, sparking excitement and activity in the housing market. But Fed rate cuts don't just stop there. They have far-reaching consequences that ripple through the entire financial system. They set off a chain reaction that impacts the entire economy, like dominoes falling, but with money. Think about businesses. When the cost of borrowing decreases, it opens up a world of possibilities. Lower rates mean they can borrow money for less, making it easier to invest in new equipment, hire more workers, or even expand to that new location. This can lead to increased productivity and growth. And when businesses are booming, people usually feel more confident about the economy. This confidence can translate into higher consumer spending. They might spend more, invest in the stock market, or even finally take that vacation they've been putting off. It's a whole vibe. This increased spending can further stimulate economic growth. But again, there's a flip side. Not everything is always rosy. Lower rates can also lead to what economists call malinvestment. This is when businesses make poor investment decisions because borrowing is so cheap. That's when businesses make risky bets because borrowing is so cheap, only to get burned later on. Remember the dot-com bubble? It was a classic example of malinvestment. Yeah, not a good look. The consequences of such risky investments can be severe, leading to financial losses and economic downturns. Section 5. The global game. How rate cuts spill over borders. Here's the thing about the US economy. It doesn't exist in a vacuum. We're talking global impact, baby. When the Fed cuts rates, the ripples are felt far beyond our borders. See, the US dollar is like the cool kid in the global currency cafeteria. Everyone wants a piece of it. So, when US interest rates go down, investors often look for juicier returns elsewhere, like in emerging markets. This influx of cash can be a double-edged sword for these countries. On one hand, it can boost their economies and make their currencies stronger. But on the other hand, it can also lead to inflation and make it harder for them to manage their own economic situations. Talk about a global game of hot potato. Section 6. Cheaper credit, riskier business? Remember how we talked about businesses borrowing more when the Fed cuts rates? Well, that can be a good thing, but it can also lead to some shady business. See, when money is cheap, businesses might be tempted to take on more debt than they can handle. They're like, YOLO, interest rates are low, let's go all in. But if those risky bets don't pay off, they could end up drowning in debt. This is where the Fed has to walk a tightrope. They want to encourage borrowing and investment, but they also don't want to fuel a bubble that's going to burst later on. It's like they're trying to inflate the economy just enough without popping it. Talk about pressure. Section 7. Emerging markets. A delicate dance with the dollar. We talked about how Fed rate cuts can send investors flocking to emerging markets. But this can be a delicate dance for these countries, kind of like trying to waltz with a gorilla. On one hand, the influx of foreign investment can be a good thing. It can boost their economies, strengthen their currencies, and even help them finance important projects. But on the other hand, it can also make them overly dependent on foreign capital. If the Fed decides to raise rates again, those investors might pull their money out just as quickly as they put it in, leaving these countries high and dry. It's like a bad breakup, but with potentially disastrous economic consequences. Section 8. Inflation Nation. The Fed's constant worry. Remember how we talked about the Fed's balancing act? It's a delicate dance they have to perform every single day. Well, one of the biggest things they're trying to balance is inflation. It's a constant concern that never really goes away. Think of it like this. Inflation is like a party guest who eats all your snacks and drinks all your beer. They start off fun, but soon they overstay their welcome. A little bit is okay, but too much, and it ruins the whole vibe. Suddenly, the party isn't fun anymore, and everyone wants to leave. When the economy is doing well, people have more money to spend, and businesses can charge more for their goods and services. This is generally a good sign of economic health. That's all well and good, but if prices rise too quickly, it can lead to inflation. And inflation can erode the purchasing power of your money. The Fed's job is to keep inflation in check. They have to make sure it doesn't get out of control. One way they do that is by raising interest rates when the economy is overheating. Higher interest rates can cool things down, but when they cut rates, it can make inflation worse. Lower rates can stimulate spending, which can drive prices up. It's like they're adding fuel to the fire, hoping it doesn't burn the whole house down. It's a risky move that requires careful consideration and timing. Section 9. The bottom line. Rate cuts, a powerful but tricky tool. So, there you have it. Fed rate cuts, a powerful tool that can boost the economy, but also one that comes with a whole lot of risks. It's like giving a monkey a chainsaw, potentially useful, but also potentially disastrous. The Fed has to carefully weigh the pros and cons before making any decisions about interest rates. They have to consider the impact on everything from the housing market to the global economy, all while trying to keep inflation under control. It's a tough job, but hey, somebody's got to do it. And next time you hear about the Fed cutting rates, you'll know exactly what's at stake. Section 10. Looking ahead, what's next for the Fed and the world? So, what's next for the Fed and the global economy? That's the million-dollar question, and unfortunately, I don't have a crystal ball. If I did, I'd be chilling on a yacht instead of writing this essay. The Fed's decisions about interest rates will depend on a lot of factors, like inflation, unemployment, and global economic growth. They're constantly monitoring the situation and trying to anticipate what's going to happen next. One thing's for sure, the global economy is interconnected now more than ever before. What happens in the US affects the rest of the world and vice versa. So buckle up, because it's going to be a bumpy ride.